Rolling over your employer retirement account and the Pro-Rata rule. Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, I'm going to touch on a question I got just the other day. And somebody asked me, hey, I'm rolling over my 403B and I heard something about a pro-rata rule. And they asked if that was a tax or if that applies to them. So I figure, with a lot of this stuff, if one person has the question, then there's probably more who have a similar question. And we might as well jump into it. When we're talking to 403B, a lot of what we're talking about when we're talking about rollovers or direct transfers, the rules, the same logic can be applied to your 401ks, your TSPs, your 457, and any of these retirement accounts really. And when we're talking rollovers, right? So in this instance, the person who was asking me, they left an employer that had a 403B that they contributed to for years, and they wanted to roll it over into an IRA. And usually that's a good idea, unless you really like the investment options within the retirement account with your employer, or there is the ERISA protection that comes with these retirement accounts. But a lot of times you see people who want to consolidate, right? We don't want a bunch of 401ks and TSPs and all this stuff all over. Let's roll it all over into an IRA. It's kind of easier to manage and just consolidates things, right? Simplifies things. So it's pretty common to see. Not always the right rule, but a lot of people like to do that. And when we're talking about rollovers, there's kind of two ways you can do a rollover. And this applies to IRAs as well as these retirement accounts, 401ks, TSPs. What I like to say is I like to use the terminology direct transfer, right? We're doing a direct transfer as opposed to a rollover. Now, this is kind of nuanced because a direct transfer is a rollover. But the reason I like to use that kind of terminology is there's a couple ways of doing a rollover. And one of them you sometimes hear is the 60-day rollover. And in this rollover, what you're actually going to do is liquidate your account to where the custodian writes you a check, right, for this amount. And then you have 60 days to deposit this check into the next retirement account to complete the rollover. And if you don't, there's a whole, you run into a bunch of issues there with taxes and distributions and a bunch of things. And to me, nowadays everything is so automatic and direct transfers and just, ACH, credit card transactions. It's so much easier, and we eliminate the check aspect of it if you just do a direct transfer, which is just a ACH transaction. It just goes from one account to the other. The custodian does it. There's no issuing a check, right? And that's why I always like to use the terminology direct transfer, which is also a rollover, right? It's just a different verbiage to use there. Okay, so when you're doing this, right? There's tax considerations because in a lot of these retirement accounts now, especially, recently there's the Roth and the pre-tax options in all of these 457s. You're seeing it in the 403Bs, 401ks, TSPs, right? There can be a mix of Roth and traditional or pre-tax assets there. And when you're doing these transfers, you got to put the pre-tax in the pre-tax IRA and the Roth in the Roth IRA, unless your intent is to do a conversion, right? A Roth, you're going to convert the pre-tax into a Roth, then you can put the whole thing into a Roth IRA. But you just got to be cognizant of what funds are coming out. Are they pre-tax, are they Roth, or are they a mix? And I think this is where the individual who is asking me about it came upon the pro-rata. And because the pro-rata, so if you do a partial rollover, let's say you have a 403B or 401k with a mix of both pre-tax and Roth funds, when you ask to do a partial rollover, so you're not rolling over the whole amount, that money is going to come out pro-rata, meaning proportionally, right? That's all pro-rata means, just the legal term for proportionally, a mix of pre-tax and Roth funds, right? You can't necessarily say, okay, I'm going to do this. I'm going to roll over, do a partial rollover. I'm going to roll over a little bit, let's say 50,000 out of this 401k and put it into my Roth IRA, and I just want to move the Roth funds. The custodian's going to say, okay, you can do a $50,000 rollover, but that is going to include both pre-tax and Roth. Now, there's some custodians which I'm not aware of that may be able to separate them out when you're doing a partial rollover. But most times, this is where the pro-rata rule comes in. They say, here's your 50,000, 20,000 is pre-tax, and 30,000 is Roth. Right? So you need to keep track of that. And when you do this rollover, let's say your intention was to do a conversion, right? You have pre-tax and post-tax in there, and you want to roll it all over into a Roth IRA, and you know you're going to pay the taxes on the pre-tax money in that 401k or 403b. You could do it a couple ways. You can do a direct transfer of the whole amount into the Roth IRA, right? And you did your conversion in that one step. Or you can make it a two-step transaction. So let's say you have a traditional IRA and a Roth IRA set up. You can roll over funds, put the pre-tax in the traditional IRA, put the Roth funds in the Roth IRA, and then after it's settled and in those accounts, convert the traditional IRA, move the funds into the Roth IRA, right? So you kind of take a one-step transaction and make it a two-step transaction. Depending on what you're trying to accomplish, that's fine. It doesn't really hurt anything, but most times you can just do the direct, put it in the Roth IRA, and you do the conversion and the rollover both all in one step instead of the two by putting it in a traditional and a Roth IRA. And so that's kind of where the pro-rata rule comes in. So with a partial rollover, obviously partial, you're not rolling over the full amount. If you're doing a full rollover and you have both traditional and Roth funds in there, and you don't want to do a conversion because when you do that Roth conversion on those pre-tax funds, you're gonna pay the tax bill on all that, right? Because you haven't paid taxes on that yet. Then you want to set up that traditional IRA and that Roth IRA. Your custodian most likely will be able to tell you which amount is traditional, which amount is Roth, and you roll those two into those two separate accounts. And no conversions have been done, but the rollover has been done, right? So there's conversions and then there's the rollover. And it's all about what you're trying to accomplish here. And custodians, and by custodians, I mean whoever, like if you have a 401k, it could be, the Fidelities, the Vanguards, or it could be whatever it is, right? Whoever is the brokerage firm or the custodian of the account. Sometimes there's different rules around these 401ks, 403bs, 457s as far as in-service, distributions, in-service rollovers, rolling money in to those accounts, rolling money out. So every custodian, there's definitely some nuance, and it's always good to just pick up the phone and call them. I like to think they're working for you, right? You have your money. It's like a bank, right? You put your money in the bank, and now you're a customer, right? So you should be able to go to them at any time, give them a call and say, hey, what's going on? This is what I'm thinking. Can I do this? What are the rules around this? And they should be able to spell it out for you. The last thing I want to say about pro-rata is you hear a lot about the pro-rata rule as it pertains not from a 401k, 403b rollover, but just doing IRA conversions. There's a pro-rata rule there where, let's say you have a mix. So if you earn too much, and I talked about this recently on previous episodes, if you earn too much, you can't do a Roth IRA contribution. You can't do a deductible pre-tax IRA distribution. But even if your income limit is super high, you still can do non-deductible contributions to a traditional IRA. Now, the pro-rata rule you hear about with IRA conversions is when you do a traditional to Roth IRA conversion, even though the funds may be coming out of one IRA, one traditional IRA, if you have two other traditional IRAs, and there's a mix of non-deductible and deductible contributions in there, that conversion is going to come out pro rata. They're going to aggregate all of your traditional IRAs together, and it'll come out pro rata in the conversion to the Roth IRA as far as the amount of non-deductible contributions and deductible contributions. And why that's important is the tax implications there, right? You don't pay taxes on the non-deductible contributions. You pay taxes on the gains in those traditional IRAs, and you pay taxes on the distributions when you did take a tax deduction for those contributions. But non-deductible contributions aren't going to get taxed because that would be in essence a double taxation. You already paid the taxes on those funds. The gains from those non-deductible contributions will be taxed because it's in the traditional wrapper there, right? So I'll leave it there with the pro rata rule for the IRAs. But I thought this was a good question to bring it up, talking about direct transfers or rollovers and the pro rata rule as it pertains to partial rollovers from these retirement accounts. All right, if there's anything in particular you'd like me to talk about on the show in the future, please email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.